this is a summary of all the different chapters you've covered so far. Okay, we've looked at the managerial function. Okay, this will be theory that will come up in tests and exams, and the theory will relate to things like corporate governance. Okay, the agency problem is something that will always be tested. Okay, that's a very big focus, right? And obviously the role of a financial manager. So what must they do? Okay, what are their responsibilities? Right, then you've got the operating environment. That's looking at primary and secondary markets. Okay, remember we spoke about primary and secondary. Does anyone know what the difference is? Is when you first do what? Correct. When you first issue financial instruments in the market. Okay, then we looked at ratios. Here's your first calculation, okay, that could come up from a test point of view, or that will come up actually. All right, they do like ratios, so make sure you study all the formulae. Okay, remember ratios are easy if you've got the equations. Right, then it's just playing with the formulas to try and get the right missing figures, numbers. Okay, then you've got capital budgeting. Right, you guys looked at some of the techniques. So we looked at things like payback period. We looked at things like net present value. Okay, one or two of those shorter type of calculations. Okay, right, nothing too complicated there. Okay, time value of money is looking at what? Discounting or compounding. Right, and that's a very, very important section because you use it here and you use it there. Okay, time value of money is also standalone. Okay, so we can work out present value, future value of certain amounts, but it can also be applied to bonds and shares. Okay, then we looked at CAPM and we had a look at risk and return. Okay, how do I measure risk? Different measures are standard deviation, coefficient of variation, right? Range. Okay, so are you going to need to know that? Yes. Okay, there's a table method that I've given you to help you draw up or work out all of those amounts that you need from an analysis point of view. Okay, then CAPM, what's the equation for CAPM? CAPM is required return. Required return is risk-free plus the beta times the KM minus the RF, risk-free. Okay, you'll see this later in the slides. I'm just recapping things that are important in terms of calculations. Okay, so if you know your calculations well, you can actually almost pass the exam. Okay, because everything in blue is a calculation. Ratio is a calculation, time value of money is a calculation, bonds, CAPM, and share or stock valuation. Those are all sections where you need to know how to calculate something. Right, the theory you need to study. Okay, so you need to go over your notes, you need to go over your textbook, you need to be familiar with the different sections from the different chapters. Okay, but the blue is what you can all do well in terms of calculations, because you don't study calculations, you practice. Okay, so you do questions and you prepare yourself for that particular question. All right, so let's start off. The first bit. What's the goal? There's the answer. Generating wealth or value for who? Shareholders. Okay, profit is an accounting measure of value. Okay, that's something to consider in terms of goal. Okay, the primary goal of any firm is to maximize wealth. That's key. Right, then you get two types of markets. You get primary, you get secondary. Okay, we spoke about primary as being the first time you list, which is an IPO, initial public offering. Secondary market, JSE, it's an exchange. Okay, an exchange is a regulated marketplace where people can buy and sell certain assets. Okay. Then you've got shareholders and stakeholders. What's the difference? Correct. And what do they want? They want benefits. Do you agree? Okay. Stakeholders want benefits. Shareholders want profit. Okay, so there's a difference in terms of, let's say, focus. Right, the focus is slightly different. There's a conflict of interest. Okay, because who acts on the shareholders' behalf? Yes, and the directors are stakeholders. They're employees. Okay, so if you're the director, if you're the CEO, right? Okay, you're determining how much to pay out in terms of bonuses. Okay, and who to give out those bonuses. If the company does well, bonuses have to be paid. Do shareholders want big bonuses? No. All right, they don't want more costs. Okay, so do we pay out a bonus or do we keep profit in the business? Okay, there's a trade-off between keeping the shareholders happy and keeping the stakeholders happy. Right, and because we have people acting as agents, there could be a problem. Okay, shareholders and stakeholders don't have the same focus or goal. Okay, so stakeholders can perhaps act not always in the best interest of the shareholders. Right, then we looked at ratios. Okay, as financial managers, we need to make decisions. Okay, so how do we make decisions? We need information. Okay, and who provides us with information? The accountants. Okay, accountants draw up those statements. Okay, statements for the company, statements for a specific business unit, statements for a specific product. It all depends. But you've got 4 statements to look at. The first one looks at profitability. Again, how do we calculate profit? Income minus expenses. Okay, then you've got statement of financial position. And how do you calculate that? Assets minus liabilities. Okay, then the last is obviously changes in equity, which is your owner's equity, which is your OE. Okay, statement of cash flows. What is that? Inflows and outflows. Okay, your favorite from FAC. Okay. It's a nice important section there because it affects this. Okay, you need to know how the cash is flowing to determine if the business is actually managing its cash flow or not. Okay, is that right, guys? Okay, there's the list of ratios that you need to be familiar with in terms of grouping. Okay, so liquidity you need to be familiar with. What is liquidity? Someone define it. Yes, okay, so having cash available to do what? To pay certain short-term liabilities, obligations. Okay, so liquidity is having enough available to meet obligations. Okay, activity ratio. Think about operations. Okay, so what will we look at there? We'll look at your margin, your sales. Okay, so all those ratios are looking at sales, gross profit margin, net profit margin. Right, it's operational in nature. Okay, then you've got debt ratios. Debt is looking at the extent to which you have liabilities in your business. Okay, do companies want lots of liabilities? No. Well, aggressive companies do. Okay, companies that are looking to expand will have a lot of debt. Okay, profitability, that's looking at your return. Okay, so return on equity, return on assets. Okay, that's profitability. How profitable is the company in terms of generating a return? Right, don't forget this. Why is that important? DuPont. Okay, remember DuPont uses net profit margin and total asset turnover. If you group those two, you get ROA. Right, so there's 2 equations for ROA. Right, the one has the profit over the assets, the other has net profit margin times total asset turnover. Okay, then you've got market ratios, you've got the PE, you've got the EPS, you've got the DPS, and you've got book value. Okay, DuPont always gets tested. Okay, so make sure you know that equation. Right, the DuPont equation is net profit margin times total asset turnover times financial leverage multiplier. Okay, so it's looking at 3 different components that make up your return. Okay, your return on equity. Okay, return on equity comes from different things. It comes from this, which is operations. It comes from this, which is utilization of assets. And it comes from that, leverage or financing. Okay, how much debt or equity are you using in the business? Okay, is that right? Time value of money. You need a financial calculator for this. Okay, you need to be comfortable using the financial calculator in terms of its functions. Okay, so what variables do I have? I've got 5. Okay, what does the N represent? Time. The I? the rate or the interest. What does the payment represent? The payment represents an annuity. Okay, remember, if the payments are all the same, you have an annuity. What is an annuity? It's a series of similar amounts, okay, that occur over regular intervals. Right, so you only use payment if you have a annuity type of question. Okay, one amount appearing more than once over a regular period. Okay. FE and PV, FE is obviously at the end, PV is at the beginning. Right, what must you check with any question? You need to see that everything, yes, everything relates. Okay, so if you've got months, everything needs to be in months. And which is the most important variable? The payment. Okay, because you can't change the payment unless you restructure the loan. Okay, so we need to focus on the payment when looking at time value of money. Okay, whatever the payment is. If the payment is half yearly and you've been given years, you'd convert your years to half years. Okay, is that right? Yeah. Okay, let's see if you still remember how to use your calculator. What's wrong? Sleepy today? Oh, hectic weekend. Okay. Right, try work out those two. Robert can do the first one, you can do the second one, Tammy. Doesn't matter, you need to do both. Okay, but we'll ask each of you for an answer. Okay. Let's wait for the answer for the second one as well, and we'll check both.
Obviously, it looks like easy to come here to do it again. You do it again afterwards. It's like, it's easier, of course. It's always easier somehow.
Okay, what did you get for A?
48,519.
Yes. What did you get for B? Good. Alright, so you guys know how to use the calculator. Very good. What happened?
Equals 120, which is right. Says the I for me, 10% divided by I times it. Also, I did both when I was measuring.
Okay.
Don't interrupt it there. So I just did it this one, make sure. Done.
Okay, happy. Alright, so try the next two. Let's see if we can work out C and D. A?
I'll do C then.
You have to do both.
Yeah. Oh, yeah.
Okay, you do both.
The one we speak.
You do both. I just check his answer and I check your answer. Okay, but you have to do both.
Yeah.
Right. Okay. Compound? Ooh. How many quarters in a year? How many quarters in a year? 4, so?
Why do I get 3?
Because each quarter is 3 months.
See, that's all.
Okay, yeah, each quarter is 3 months. Makes sense. Happy. Yes or no? What did you get?
For the first one.
Have you done both?
I've only done the
Do both.
I'm just doing the second one. Let's see. So it's trying to interrupt you and you're saying good job at the calculator. Sorry about that. Just to make sure.
What are we getting, guys?
The first one I've got is 36341.28.
Okay. Name your second one.
3959.
Yeah, it's good. Okay, 36.
Yeah,
341.
341.
Good. Alright, great. You guys know how to work out future value. Okay, so that's PV and that's FV, right? Simple calculation on the calculator. Okay, you guys happy with those two? Right, now we've got an annuity, right? What is an annuity? Well, there's a timeline to show one. Okay, if I look at an annuity, I've got this, that, and all of those amounts. Okay, what's common here? They're all spaced evenly apart. And what else? They're all the same amount, correct. Okay, so when you see that, do you have an annuity? Yes. What button do I use on the calculator? PMT, correct. Okay, so I want the PV for this stream of cash flow. Quickly work it out.
PV, right? Yeah.
Yes, you are. You're working out the PV.
I get this answer. I don't say that because thanks for doing it.
Yeah, we'll check just now.
I don't really understand it, so I don't need to answer.
What are we getting?
So that is 14419.
Yes. Happy with that. Okay, well, these are basic skills that you need to know to deal with something that does come up in the exam. Okay. Happy with that? Okay. Now, what do I do here? Same or different amounts?
Using cash flow, different amounts.
Correct. Okay, so the key here is use the cash flow. Exactly. You don't have to do it separately. Okay, if you wanted to, you could take this and move it back. You could take this and move that back. And then you could add up those two amounts together. Okay, if I add the two amounts together, I'm going to get the net present value, which is an easier way of working it out using one step on the calculator. You can do it either or, doesn't matter, as long as you get the same answer. Okay, so work out PV, guys.
You just repeat it, I'm confused here. You just repeat what you just said.
You can either take each amount back separately, add the two amounts together, you'll get the NPV. Or you can do it in one step on the calculator. Okay, so if you can do it one step on the calculator, it's simpler.
Thanks, man. Sorry about that. I get 22985.1473. Is that right?
Do you get the same thing? You don't. Let's see who's right. 22985.
Yeah, 229.
Did you get that?
Yes, I did.
Did you get that? What went wrong?
Second fraction NPV, that's what I found.
Did you put that on your calculator? Did you do that on the calculator? Y0, Y1, Y2, I, solve. Did you? What button are you using on the calculator? You should be using the CF button, eh? Cash flow, CF.
And then the other side, I just want you to not calculate the future value on the right hand side.
Yeah, if you wanted future value, you would just take this amount forward. That's it. Yes, no, maybe? Get what? 22985. Okay, that's all you needed to work out. Okay, don't worry about the right. I've just put a working here. If the question said work out the future value of 12,015, then what would it be? It'll be your present value moved forward. Okay, taken to time 2. Okay. Happy? Sure? Alright. Next bit. Nominal and effective. What's a nominal rate? What is a nominal rate? It's quoted rate. Okay, do you use quoted rates in calculations? No. Okay, so the effective rate takes compounding into account and it looks at reinvestment, okay, in compounding. So, can I increase the number of compound periods? Yes, I can. Okay, if I've got a year is how many periods? One. Okay, if I split that into months, how many periods will I have? 12. Okay, so have I made more periods or less? I've made more periods. So if I've made more periods, what happens when I increase the number of periods during the year? The future value will get bigger. Okay, you'll have a larger future value. Why? You've got more compounding. Compounding. Okay, and with more compounding comes a bigger R, not R, FE. Okay, right, the R is your rate. Right, is there a limit to this? Yes, there is. Continuous compounding is the limit. Okay, so if I continuously compound something, meaning the periods are so small, there's an infinite number of them. Okay, I would then have PV times e to the power IN. Alright, so here's an example for you to work out, okay, in terms of find the future value. Okay, the key word here in blue is continuously. Okay, so if something is continuous, I need to use that formula. Okay, so grab the scientific calculator rather, okay, and use the E button and solve. And let's see what you guys get. Why not? What's the formula, guys? FE equals PV E I N. So the first one,
20,000, yeah, that's like that, right?
what are you getting? 2544. Yes or no?
I got the same.
Okay, so A's answer is 2544. Good. See if you can work out B's. We get those.
I got 6487.
Okay, are you happy with both?
No, I got 16487.
16487? Right.
Or 2127.
Okay, so let's see if you guys can apply the time value of money to a question. Right, so you've got a few examples here. You've got two of them. Okay, so you and your spouse are going to establish a university fund for your newborn. You would like to have $1 million when your child turns 18. Using an expected rate of 10% compounded monthly, how much do you have to deposit monthly to achieve that goal? Okay, and the fees must fall happening and all of that. That's probably a lot of newly married couples' problem. Okay. Yes. Okay. There's protests happening as well now because of the announcement yesterday.
8% or less increase.
Okay, so let's hope it doesn't get out of control like it did last year.
So last year there was a lot of protests.
How much a month?
165.103.
Do you agree? Let's have a look. 1665, yes. Okay, so if we put away 1,665 Rand 10 cents, getting 10% compounded monthly, in 18 years we'll have $1 million cash. Okay. Alright, so you see this is applied finance. Okay, time value of money. Okay, let's continue. Right, so you're planning to retire 20 years from now. Okay, you need to know how much capital must be available for retirement in order to provide a monthly annuity of 100,000 per month for the next 30 years after retirement. Okay, your estimate, you estimate an average rate of 8% compounded monthly. Okay, so I can get 8% compounded monthly throughout the next 30 years. Okay, so from now up until retirement, okay, and after, I can get 8%. Okay, so what lump sum am I going to require today to provide for it, and what is the monthly contribution going to be? Okay, so two questions here. Okay, we need to know how much capital must be available, okay, in terms of the lump sum, and how much do we need to contribute monthly. Okay. Okay, what did you get as the first answer?
I'm not sure how to do it.
Alright, so in terms of capital, how much do I need? Okay, so that's now, that's 20 years, that's 50 years. Okay, and the payment that I need each month is 100,000. Okay, how long is that going to last for? 30 years. Okay, so what's the present value of the annuity? Okay, so how much are you going to need 20 years from today? That's the first step. Okay, once you've got that amount, then you bring it back to times 0. How much capital do I need today? Do you agree? Okay, so can you guys work out that? Did you work that out already? Is that what you're asking for?
No, well, I said that, I did say that 20 times 12.
Yes.
Then I times that by the 100,000.
No. You can't times that by 100,000 because 100,000 is your payment. 100,000 is your payment. Do you agree? Okay, you're mixing the variables. Try again.
There's to do it again.
Why are you saying the 8% divided by 12 if it's already in?
Because it's compounded monthly. That's nominal. That's quoted. That's a quoted rate. As it stands, that's a quoted rate. Effective is 8 divided by 12.
What's answer? That's what I think it's about 8.
You're getting, let's have a look.
What do we press? What do we look at? Future value or present value?
Present value, obviously.
Present value, sorry.
Okay, so that's how much you'll need. Okay, when?
Yeah, I get that answer. Sorry, I didn't press it today.
Okay, that's how much you'll need when?
In your retire, it's like
When?
50 years.
20 years time. Okay, so in 20 years time, alright, if you've got 13,628 in capital, okay, that will be more than enough to provide 100,000 a month for the next 30 years during retirement. Okay. That's not how much you've got today. So how much would you need today to get that amount in the future? So now what do? This becomes the FV for step 2. Do you agree? Okay, so now work out the present value. How much capital will you need today to have this in 30 years, 20 years? So now that PV is the FV for the next step. Okay, so quickly do that step. Okay, did you put in 100,000? Did you put in N as 360? Did you put in I as 8 divided by 12? And what did you solve for? FV or PV? Okay, what did you get? You should be getting 13. 628. No, you're not.
Because I'm looking at
That's the retirement goal. Step 1 is to know how much do you need at retirement.
But where's your answer for A?
My answer for A hasn't.
I'm looking.
The lump sum isn't here yet. Okay.
I'm looking at the 0.66.
No sixes there. Yeah, that's 13,628.
The second one I get 94,292. I don't know if that's right. So I'm telling you what I should get. I don't want to rush ahead and then you stuff.
Okay, so if that's the FV, that's what I need in 20 years. Okay, so you're working at the PV today. Alright, so what is the PV today? Well, there's the FV, there's the N, there's the I. Alright, so what lump sum do you need today? You need that amount.
I got it wrong.
Okay. That's the lump sum needed today. Okay, so if you had, let's say, 3 million, right, today, and if you just saved that and invested it for the next 20 years, earning only 8% compounded monthly, right, you'll have enough, right, for 30 years worth of 100,000 Rand amounts. Okay, monthly. Right, that's a lot of traveling you could do. Okay.
A lot of traveling.
Yeah. What else would you do with the money? You're not going to leave it lying around. You do something with it.
It's too much for one person, I think.
100,000 a month is actually not that much if you think about it, considering expenses and everything.
Yeah.
Okay, but yeah, that's retirement. Save and invest. Okay. Are you guys happy with that? Okay, but that's not the last answer. B was, what would the monthly contributions be? Because we don't have 3 million lying around. Okay, so what would we have to contribute towards this goal? Okay, what would the monthly contributions be? Hey? I'm not sure. Hey. Maybe he's stuck at work or stuck with something else. He's got a new baby as well, so maybe late nights, early mornings. Shame.
Right, so now that I have that PV, I must divide it.
No dividing. You worked out PV. What else do you need to work out? Same variables here, different button on the calculator. Work out the PMT. Okay, because you've got the future value. If you work out the payment, you'll know how much you'll have to contribute. Okay, which is actually quite high if you look at this. Okay, there's the payment. Alright, but that's only based on an 8% monthly rate. Okay, 8% compounded monthly, which is very, very, very modest. Okay. You have to use N, F, E, N, and I, and you're just solving for PMT. Same variables.
FE becomes
the FE is the FE, so just put that in, put that in, put that in, press that button, and get that answer. Okay, so you're just pressing a different button instead of PV.
You're trying to pin on the top at the 13,628, the middle calculation. I don't know why you get it. 1, 3.
Okay, so lump sum needed today is that, deposit per month is that. Is that alright, guys?
Or not yet.
Still not.
I'm still trying to work at the PV, which was at 2766. I'm just trying to work that out. I get 277. That's right, 277.
Begin mode or end mode? What mode is your calculator?
End.
Yeah, that's fine. Did you put those amounts in?
Yeah.
Maybe there's rounding here. Put lots of sixes.
That's must be why.
Okay.
I think that's how. That just put 3 if you did.
Put more.
But every time I just bring my iPad out.
Yes, that's the better way of doing it.
Yeah.
Okay, maybe do it that way as well. Okay. Is that right? You got it? Did you get it?
So I'm going to try it one more time. Sorry, keeping you waiting.
And the neural we need to do is create an app to teach how to what its subjects.
I want to do YouTube stuff. I have something already that I want to post. I'm going to send it out to you guys, and then you guys can comment and see what you think. But because you guys know the accounting, actually it's more for the accounting students, because the accounting students there's a lot more demand in that sense. I don't find there's much demand with this, because no one's doing the finance stuff.
Yeah, it's compulsory.
Yeah. Well, but I don't know how to do apps. I'm not a techie person.
Create all the work that goes in, but when you go to an app company to create it for you, obviously you need money for that, but this is not here.
Okay.
Then you can either sit on your phone, obviously, in your spare time whatever, and then there's a demo to actually listen to it and see how it's done.
Yeah.
And then if you're driving in your car, it reads it out as a like a PDF format, it just reads it out to you. So while you're driving, getting all this information.
Yeah, that's a good idea.
And if there's any questions, then post questions to you.
It's clever, but yeah, it's.
But I need that in my life. I pay for that. But unisa needs to do it for every single subject, even like the others that are just theory. You literally sit in your car, your phone reads it out of it, and at least you can go through that work 20 times before you
It's not a bad idea. Yeah. There's a few ideas, but I just haven't had time to look at all of them. I've even mentioned a few to you before, but I need to find the time to do it. Yeah. Which one? This one?
The 23137.
Type that in, and press PMT.
I press PV, which will get the 276. Now I must just press PV.
No, you don't press. Once you've got the PV, then that's the end of that calculation.
Yes,
right, this is a separate calculation.
So I must type in the first.
You type this in again, and you just solve for that.
Sorry about that. I'm being confused now. Okay, now let's just stop confusing this account. Got it.
Okay.
Because what I've done now, all my economics are typed out in PDF, and now I sit in my car and listen to it while I'm down. I don't know.
So what do you use to read it out though?
You download a random app that reads out
PDFs, and it actually.
It'd be great if there's an app.
But it actually reads it out. It actually. Okay, so you can show us just now, but okay, let's just finish the next 2 bits, and then I'm going to leave the stats for after the break. Okay. All right. So there's 3 different preferences. Okay, risk indifferent, risk adverse, and risk seeking. Okay, which of the 3 do financial managers need to follow?
Risk adverse.
Why do they need to follow risk adverse? Correct. Okay, so if I increase the risk, I need to increase the return. Okay, you're not going to be taking on more risk if you're not going to be getting a sufficient return. Okay, that doesn't make any sense. Okay, so we need to look at trying to maximize return, okay, as much as possible, but not risking too much in the process. Okay, risk indifferent, no change in required return if risk changes, and risk seeking, well, diminishing returns if I actively look at more risk. Okay.
So risk averse is
Risk adverse is the best way of managing a business or managing finance, because if you're going to be taking on more risk, you want a bigger return, okay, in line with the risk. Right, and that's CAPM. Right, so here's the note about your risk measurement. Okay, you are going to need to know how to calculate expected return, variance, standard deviation, and coefficient of variation. Okay, so remember the table method helps you with which two? Those two. Okay, you don't need to remember those fancy statistical equations. You just need to remember this, the coefficient of variation and the standard deviation. Okay, if you know what those two are, right, you'll be able to get those answers from the table. Okay, so standard deviation, square root of the variance. CV is standard deviation divided by expected return. Okay, does?
You need to understand if we got right up and multi in the exam.
Yes, I've seen it once before. Okay, but the table wasn't complete. They only gave, I think it was 3 or 4 columns, and you needed 6. Yes, they didn't give enough columns. You could have just split your column in half, and then you would have had 2 extra columns. Yeah, but they will accept it. As long as you show all your workings, it will be accepted. They actually use it in a different module, okay, but they don't use it in this module. I've just given it to you because it's easier to do. Okay. Alright, so there's the steps.